started.
Great, and you can hear me okay? You can hear me okay? Okay, great.
Yes.
Great. Hi, everybody. I'm Jason Starr, Managing Director at CompanyFirst. I'm going to dive right in and try to get through the slides and then try to save time for Q&A. Quick disclaimer, I'm violating a lot of the rules that I talk about in terms of ugly slides. So just saying that in advance because this is dense material and hopefully all of your pitch decks look a lot better than my presentation. So very quickly, a little bit about CompanyFirst, do a little bit of background on private equity, talk about fundraising and pitching your company, some elements of closing the deal, and then for reference, I put some more information that we won't go over on kind of the venture capital private equity industry. Just a little bit about CompanyFirst. We are an early stage consumer focused venture capital firm here in Chicago. I've spent about the last dozen years at various private equity and venture capital firms, both here in Chicago and in Silicon Valley, with a focus consistently on consumer businesses. Some examples, some of our investments there to the right. Again, kind of a consumer focus, so everything from food and beverage to personal care, apparel, outdoor. We like tech-enabled businesses, so companies that have a strong e-commerce channel, for example. And then we do have a social impact mission aspect to what we do. So this isn't required, but we report to our LPs the elements of our businesses that are, for example, organic and non-GMO foods, high diversity, potential for job creation, et cetera. So we provide a scorecard to each of our LPs with part of our quarterly reports saying what percentage of their money is going to each of these buckets. So a quick primer on private equity. A lot of you are going to know some of this, but just to kind of level set, the difference between debt and equity. Debt is where you take out a loan, you pay back the principal plus interest. It usually sits senior, so when a company gets sold, the debt gets paid back first. Debt is less typical for an early stage business, and the folks that are issuing the debt are typically less involved. And they actually may even require you to collateralize that loan, either personally or with the business. There might be covenants and fees. So very different for taking out a loan and less typical for an early stage business. Now, equity is more typical for startups. Now, still a relatively small percentage of companies are funded by traditional venture capital firms, but equity is the more traditional route, whether it's a VC firm or friends and family, whatever. And that's where you give up a percentage of your ownership in exchange for capital that goes into the business. There's various levels of rights and preferences, which we're gonna talk about, but there's really no due date. There's no date upon which you owe that capital back. There's higher risk to the investors, and so there's a higher return expected, and therefore, equity is more expensive to your business than debt. And the investors are typically more involved, so they might sit on the board, they might have voting rights, et cetera. So we'll dive into equity a lot more here. So within equity, there is a difference between public equity and private equity. And when I talk about private equity, I use that as the generic umbrella term that talks about venture capital, buyout funds, mezzanine capital, et cetera. So public equity, we all know the stock market, a company has an IPO, those shares are priced on a real-time basis. There's a certain amount of information that has to be disclosed to the public. It's a liquid security, so you can buy and sell it and don't have a particular amount of time that you have to hold it. Private equity, on the other hand, the information about the company is private. The deal itself is private, so you have to be part of the investment that's happening at the time that it goes on. You might not have the same level of data that you have on a public stock, but if you do make an investment, typically you're going to hold a larger share in the company. You're going to have heavier influence. You could be an advisor or a director, or at least a shareholder that has a certain amount of voting rights. But it is an illiquid security, so you have to hold that equity until there is some sort of a liquidation event. So within the types of private equity, this just kind of shows the spectrum of risk and return on one side, size and stage of company on the other. You start with angel investors, which is typically the first money in. They are oftentimes friends and family, early stage businesses, high risk still. And then you move to venture capital, into growth capital. And then you get from venture capital into the realm of private equity, which is more what people talk about in terms of either mid-market PE, leveraged buyouts, and mezzanine. Mezzanine actually starts looking like debt. Along with that, there's kind of this development and funding cycle that companies go through. starting with kind of angel and seed capital where you're focusing on developing a product, right? The red line kind of shows where you are from a cash flow perspective. So in the beginning, you're spending a lot of money to build the company, develop the concept, and launch your product. And that's typically when you raise angel or seed capital. And then you move into the phase where you're developing the business and you've launched the product and you're growing your top line revenue. And that's when you would typically raise venture capital. And then later on, as you focus on margins and become a more profitable company, that's when you might be either invested a larger round by a larger private equity firm or actually acquired by a private equity firm or even a strategic company. So the red line shows the evolution of cash from burning cash to becoming profitable. We refer to that red line as the J curve. So where does private equity money come from? Well, the folks that invest in private equity funds are referred to as limited partners or LPs. And those could be high net worth individuals, family offices, foundations, et cetera. And now they might go through an outsourced investment manager or a fund of funds, but eventually their money goes into a private equity fund. A private equity fund is what we refer to as the general partner or the GP. So you have GPs and you have LPs. And it's the GP's responsibility to invest into the portfolio companies and to report back to limited partners how their investments are doing. So kind of the structure of the VC or private equity firm and why this is important. So limited partners, again, invest into a fund. They're not involved in the decision-making process. They're paying an annual management fee, usually of 1% to 2% for the general partner to be able to manage their money. They're contributing capital as needed for deals. So if an endowment puts $5 million into a venture capital fund, they're not writing them a $5 million check up front. They have a $5 million commitment, and then they're sending capital as it's called to do deals. And then they're paying what's called a carried interest. Many of you might have heard politically about the carried interest debate. Carried interest is where the general partners basically make a percentage of the upside. So that's the second way in which the general partners make their money. And the limited partners understand that it is an illiquid or longer term investment, but they do expect the fund to have a set or limited life. So a couple of implications for the companies. One is you need to know that this capital call process exists. So there might be a delay from the point which a venture capital firm or private equity firm has committed to a deal or closed a deal and the funding. And then also you need to understand that once you take money from venture capital, private equity, the expectation is that they are going to be able to get the money out. So the general partners on the other side, they run the fund. The general partners generally contribute some percentage to the fund. Oftentimes that's between 1% and 5%. And again, they're taking that management fee. It's really more of a loan for their operations because they still owe that money back to the limited partners before they get any carried interest. So if I have a $100 million fund and I've invested 80 million of that because the rest of it was for the management fee, I still owe $100 million before I collect on my carried interest. But once I exit companies and have returned above that $100 million, I get paid carried interest, which is typically 15 to 20% on that upside. And there's more intricacies there that might be a hurdle or a catch up or whatnot, but that's the basics, what people refer to as the 2 and 20 rule. And then the general partners are responsible for winding up or winding down the fund at the end of that term so that the limited partners can get their money back. So fundraising and pitching. So I think it's important to kind of start with understanding the goals. The goal in each step of the process is to get to the next step in the process. So very rarely do you sit down, give a 30-minute pitch, and then somebody whips out their checkbook. You need to understand the process and who the decision makers are. You're going to eventually need to get those decision makers, whether it's an investment committee or head of the family office, to make that commitment. And your goal is to get your business financed with a minimal amount of time, friction, and impact to your business. You're the right for your business. And I know everybody focuses on valuation in terms, but as I'll continue to talk about throughout this, really the most important thing is to minimize the impact to your business because you do get pulled away to go raise capital. And you don't want to take your eye off the most important thing, which is running your business. So kind of at a high level, what I'm going to talk about in terms of raising capital is it's important to build a great business versus just a great product. And all of these I'm going to talk about in more detail. It's important to develop what we call a VC backable business. And there is a difference between a good business and a VC backable business. You do want to find a good lawyer. And I know nobody wants to pay legal fees. I don't like to pay legal fees, but you will need a good lawyer, and a good lawyer will actually save you money in the long run. You're going to need to do a lot of preparation in terms of your presentations and information that goes in the data room. You need to spend a lot of time networking. You need to be smart, focused, and quite frankly, relentless with your networking. And what I think is probably the most important is you want to practice what I call courteous persistence, and I'll talk about this, and transparency, because the people that you bring on as your equity investors are your business partners. And so you want to be open and transparent, because this is different than just somebody buying public stock. You are going to be working with these people and counting on them potentially to put additional capital in the business in the future. So again, this recurring theme that I'm going to say, that it's a focus on finding the funding for your business to step on the gas and the right partner. So what do I talk about building a great VC backable business? Yes, growth is important. And you want it to be aggressive, but also you want to be realistic, and you need to understand the difference between a hockey stick and a J curve. Hockey stick, you're talking about top line revenue. We're going to have this great hockey stick. J curve is where you are going to be burning cash and how you come out of that and eventually become a profitable business. If you don't have the J curve, if you only have the hockey stick, it's a lot harder to raise capital. Business model, this goes directly with that. You want to look at your gross margins now and over time, your scalability, and when you are going to become a profitable business. You have to have a plan, and by the plan, I'm really talking about the financial plan. So you have to really think through what your financial model is and what that's going to be over time, not just your historical numbers. You need to know your numbers. When you're in a meeting, it's okay to say, I'm going to have to get back to you on that. I don't have that number on the tip of my tongue, but you want to know your numbers as much as possible when they come in and talk about metrics and gross margins, et cetera. Team is obviously very, very important. It's probably the second most important thing. And vision is the most important thing. And it's really important to note that people don't invest in companies or even teams. They invest in stories. So you have to be able to tell a compelling story. So what kind of information am I going to need to create and provide? Well, first of all, I recommend having an executive summary. And this is a light version, usually just a couple of pages, that you don't mind if it gets out there in the public. So it's not going to have any proprietary data. You actually want that to be shared to generate interest for people that are going to come in then and dig into your business further. Then you're going to have the presentation, or what we refer to as the pitch deck, which is going to go into more detail, and we'll talk about what should be included in the presentation. And then a detailed business plan. And you do need to have a more detailed business plan. And it might still be a presentation, but this is just allowing the investors to peel back the layers of detail. And part of what you're going to want to have in there, which is key, back to the team, is the org chart. And you want to have an org chart that shows not just today, you want to have tomorrow with the funding, and then potentially even what's your plan for hiring down the road. On the financial model, I think it's important to have what we refer to as a bottoms-up versus a top-down financial model. And what I mean by that is a top-down is just, okay, we're going to extrapolate 20% growth, and this is what that would look like over time. Bottoms-up, which is what I recommend, is more of a, here's how many customers, the average sales per customers, and what are the metrics that build up into the revenue, so that you can not only say, here's our great top-line growth, but you can justify that with what your assumptions are. And then there's a whole bunch of other stuff, legal documents, insurance, leases, depending on your business, which you're going to go into a data room. So I want to talk real quick about a tool. I'll get more into the tools broader that I recommend, but there's a tool that I would say could and should be your new best friend, which is a tool called DocSend. And if you're not familiar with DocSend, it's a nice platform that has data rooms that allows you to send links versus documents. And that allows you to control access. It allows you to see who opens and actually reads your documents. And what is probably most important is allows you to refresh your documents with an updated version. So say you came out with an updated pitch deck, you just refresh that in DocSend, and then anytime somebody sends a link that you previously sent them, they'll get the latest and greatest. So you don't need to kind of, hey, I've got a new version, here's the latest version, to get it automatically. So how do I find investors? Well, I recommend you start by raising from friends and family. The amount is less important than it is to show traction and to show that people that know you the best are willing to put some money into your business. You need to network. You need to not network constantly and relentlessly, but with a smart focus. So do your homework on investors. Reach out to folks that you think would be a fit because they target your sector or they've invested in businesses like yours. Get warm introductions when you can. You don't have to have warm introductions. I've always been impressed and surprised by who will respond to you if you just ask. And you don't need to start at the top. So if you can get a foot in the door at an associate level, then start there and work your way up. And again, do what I call practicing courteous persistent. Investors get bombarded with a ton of inbound emails. It's not because we're special people, it's just because we invest in businesses. So continue to follow up. I don't mind if somebody sends me an email and just says, hey, just making sure this didn't get buried in your inbox, so to put it back at the top. I actually appreciate that. So as long as you're courteous, don't stalk people, once a week or once every other week, ping them. Ask them if they want to be on your investor updates. This is a marathon and not a sprint. So you're building an investor base over the long term. And again, I really advocate complete transparency. These are going to be your new business partners. The last thing you want is buyer's remorse, after somebody's made an investment. So the pitch, and I think, a lot of folks know this. There's a lot of articles about creating the right pitch deck, but just to give kind of my perspective, I want to start with, what problem are you solving? Why are you solving it? If you've got a founder story, a great founder story, I had a personal need for this product or service, that's why I created it. That's awesome. The vision, what's the big idea? How are you different? The word unique is, I think, a little bit overused because it's hard to be truly unique, but sometimes you're uniquely qualified. Sometimes you have experience that normally other people wouldn't have to be able to go after an opportunity. The team, the business model, as I've previously discussed, the plan for execution. First we're going to do this, then we're going to do that. These are the milestones, these are the metrics. It's really important to talk about marketing and sales. Who are your target customers and how are you going to reach them? And then a point on market and competition. Yes, you have competition. I actually get a little concerned whenever somebody comes in and says we have no competition for what we're doing, because it either means that they didn't do their homework or they're doing something that the market doesn't need. And I know some folks are probably not going to want to hear this, but the competition slide is actually more important than the TAM slide. So TAM is your total addressable market. Good to have, but if you have a TAM slide without a competition slide, then that's a challenge. And then what's your ask? You need to be clear about, this is the size of our raise, the use of funds. The deal terms can be so much of a catch-22. Some investors like to have a signaling on what you're thinking in terms of valuation. Some investors want you to say, hey, propose what you would think. So my recommendation is, if you're going to have terms in there, be high level, signal, but don't say, here's our term sheet and all of our docs are done, because investors want to drive the process. And then don't forget this executive summary. You want to distribute it broadly. You want to cast a wide net, create a large funnel. This courteous persistence, so long as you've done your research, feel free to reach out to folks. Send the presentation before the pitch. Use DocSend, have a PDF ready to go. Some people are going to email you and say, I don't like DocSend, or I can't get it through my firewall. You want to send the presentation maybe a day in advance so that it's fresh, but they've had a chance to look at it. You don't want to follow up, but don't jump to give people access to the data room. You want folks to express interest. Consider using an NDA. It can backfire, especially with earlier stage tech businesses. A lot of investors, don't do NDAs. My firm does do NDAs. It depends, but you can ask. And understand that there's between no and no for now. So ask for feedback. It's a great opportunity. Ask if people want to be in the loop. And, like I said, if you have truly interested investors that are a pass for now, ask them if they want to be on your investor updates. And that's a good way for them to get to know your business over time and maybe participate later or participate in a later round. So just touching a little bit on fundraising tools and processes. From a CRM perspective, it's really helpful for you to define your process and track all your touch points. Salesforce is kind of the big one. HubSpot is a great one. It's a free tool. It's actually what we use. People are usually using Dropbox, or I recommend DocSend. The features are just so much better, and it's not that expensive. And from a data room perspective, they've got a built-in data room. There's some more expensive ones like Intralinks, but you don't really need them. And then you want a tool for being able to electronically sign documents. HelloSign is a popular one. DocuSign's a little more expensive. We use DocuSign. I think it's a great tool. And I'm going to talk a little bit about closing the deal. So first off, and we get this question a lot, how much should you raise? And it's obviously going to be different for every company. It's really going to come out of your financial plan. So what's your expected monthly burn? What's the cost of planned hires and growth initiatives? And how much runway do you want or need? And I'll talk about that a little bit more. And then there's what can you afford? What's the acceptable amount of dilution, and what honestly is a reasonable valuation that you think you can get for your company? What's achievable, what you can realistically raise with a certain amount of time and effort. Again, you don't want to get so pulled away from your business with fundraising that it negatively impacts your business. So how much is enough? Think incrementally. I like to recommend trying to get 12 to 18 months of runway, hitting some major milestones. Understand the risk of having too much money as well. And that is really a thing. There are many a company that have raised too large rounds and then not had the discipline around spending. And then when you don't achieve the results that you promised by raising that huge round, now you're in a real bind with your next round of fundraising. So just to touch again on the point of, do I need a detailed financial model? Yes, you really do. And again, it should be bottoms up versus top down. You want to document your key drivers, any metrics or any assumptions. You want to have realistic and defendable gross margins. Margins are critical, and everybody understands that margins aren't going to be great in the earlier stages of a business. So you don't need to have the dream margins out of the gate, but you need to show that plan, that bridge, if you will, that gets you from your lower gross margins today to your ideal gross margins in 12, 18, 24 months. You need to show what your detailed payroll is, the team, how much you're paying, making sure that you're building in benefits, raises over time, et cetera. That's a huge cost for earlier stage companies. And your detailed marketing plan. A lot of folks like to say, oh, well, the metric is 10% of revenue. You need to have buckets. You need to have, these are the high level buckets where we're going to spend our marketing dollars. And realistic, operating expenses, capital expenses, add some contingency. And really, you need to have a balance sheet versus just a P&L. The balance sheet is where your cash need comes from. And you have to really understand the difference between the profits and losses at the bottom of your P&L statement and the cash, because there's a situation where good companies do grow broke, and it's because not managing the cash, thinking because you have good margins and good sales that you actually have money in the bank, and that's not always the case. So talk a little bit about types of VC deals. So for early stage businesses, you can do notes or you can do equity. And notes in this context is debt, where the purpose of the debt is to convert later into equity. So notes can be a safe, a convertible note, a demand note. Usually there's a term or a duration, an interest rate, and a discount rate that says when it converts, it's going to convert into the next round at 15, 20, 25%. It's typically not collateralized because, again, the idea is for it to become equity at some point. And then equity can take on either a common versus a preferred flavor. It can even take on what's called a participating preferred, which is where you get your money back and your percentage of ownership in the company. The actual ownership stake in the company is driven by the investment in the valuation. It's a pretty simple calculation. In addition to the share price, equity is going to have various rights like voting rights, information rights, pro rata rights. It's an illiquid security, but again, investors are going to ask for a liquidation preference, and they are expecting to get their money out at some point. And it may pay or accrue dividends. So capitalization, also known as cap tables. Cap tables is one of those areas where I tend to think companies have a real opportunity to impress investors and almost always fall short of what they could have done. I'll just put it that way. Capitalization or cap tables are where you are showing what the different groups are that are involved in your business, what they've invested, and what they paid, and in the valuation for those rounds. And the more that you can show, the better. And a lot of times we will go in and work with companies to help them clean up their cap tables, because oftentimes it's just one big messy spreadsheet with a list of everybody and how many shares they own, but it doesn't tell you the different types of shares, what they paid, the different rounds. So I'm going to take this messy slide and turn it into an example, which is the format that we like at my firm. And so this cap table example, this is a summary level example. What you see here is you have a different section of the cap table for each round. So you can see, I can plainly see what my founder shares were, how much the price they paid, the convertible note that was raised, how many different people are in the convertible note, what interest they paid, what rights that they have. Then when we got to a Series A preferred, how that convertible note converted into the Series A, exactly what price people paid for the Series A versus the discounted price people paid for the convertible note, and any specific aspects such as a liquidation preference, participation feature, et cetera. And so let's say this cap table example was for a Series A, and you'll notice that I also have a Series B here. So what that Series B is that's projecting what my future rounds are. I almost never see early stage businesses actually projecting future rounds. So I highly recommend doing that. And what you want to do is you want to say, we're projecting, and of course, you're not expected to have a crystal ball, but you're projecting what future rounds and the timing of the future rounds are going to take to get your business to either break even or to the point where you're going to stop raising capital and start funding your business organically through profits. So you want to project kind of those future rounds, and that'll also allow people on the current round to see, okay, over time, not just what percentage am I going to own after this round, but once I get diluted, or maybe I want to put in there that I'm going to show that I'm going to participate in future rounds. It's actually a good way to get your current investors to signal if they would like to invest in future rounds. So this is a high-level cap table, and then you can take that into a detailed level where each of those buckets can expand to show your individual investors. And I actually think that this is a format that's not that hard to do. And if a company comes to me and they have this format, I'm really impressed by it because it's a big part of the initial analysis that we do is usually taking their cap table and sometimes not even having a cap table, but their legal documents and having to read through their legal documents and reverse engineer them into a cap table. So if you can have this available for an investor, I think it's really helpful. And then what an investor is usually going to do with this, and again, I recommend you do it, is turn it into a waterfall. And I know this looks like a real eye chart, and so you can look at this later and see kind of how I've done it. But a couple of key things to point out. What a waterfall analysis is it shows a range of potential outcomes, i.e. valuations, how you get to those valuations, i.e. what your revenue and exit multiple could be at those times. And then how, if you exited at that level, how the proceeds would be distributed to the different shareholders. So you can see here that for a particular valuation, in this waterfall example, the distributions are first going back to pay off debt, and then we're going to the preferred stock. The preferred stock has a decision that they need to make. Do they convert or do they just take their preferred return? In this case, the preferred return is their principal accruing 8% interest. It's calculating for the preferred shareholders what their cash on cash return is. And then lastly, the common stock gets their money out. So you can see at the lower levels, the common stock actually gets less. And then on the higher levels, the common stock gets a lot more, which is the way it should be. The common stock, most important common stockholder is the founder. And so part of this analysis is being able for the founder to see, if I achieve these results, what am I going to make as a founder? Another couple of key points in here is you can see that I have some of the columns highlighted. And so what this becomes is a bit of a heat map for us. So my firm in particular, we model out to 5 times cash on cash return. So you can see that that is shaded the darkest. So we'll look at that column and say, what is our level of confidence to achieve a 5 times cash on cash return? And so that's where it's helpful for us to say, okay, an example of that would be exit revenue of $40 million and about a 2.5 times exit multiple. And then that kind of radiates out so we can see what is our chance of getting maybe up to about 7 times our money. And on the other side, what is the chance that we're going to be able to get at least 3 times our money? So the gut check for us is we have to have a fairly high confidence interval on the 3 times our money. Obviously, we know we're still accepting some amount of risk, so that's not 100%. But one high level of confidence around 3 times our money. We want to see a path to 5 times our money. And obviously, if we can see that 7 times our money is a realistic scenario, that's a great thing. So a couple of notes about raising notes. You may have heard the term SAFE. So SAFE stands for a simple agreement for future equity. And SAFEs were created, for example, by Y Combinator so that incubators and accelerators had a very simple and non-negotiable way to accept people into an accelerator. Typically, there's not an interest rate, a maturity, valuation cap, et cetera. So incubators and accelerators like this because it's simple. You don't have to negotiate anything. Entrepreneurs prefer it because it's simple and open-ended. But investors, especially funds, generally do not like safes. So just be aware of that. If you've received a safe because you've been in an incubator or won it in a business plan competition, you are probably going to need to go to a convertible note once you move, especially once you move kind of beyond friends and family to formal funds. So that gets you to convertible notes. And my comment about convertible notes is make sure you're doing a convertible note for the right reason. The company is too early, so there's really not an easy way to come up with valuation. Convertible notes then kind of push that valuation discussion for the next round. Another good reason is that the founder has limited resources to spend on lawyers. So there's a bunch of convertible note templates out there. I'll talk about a few of them. It's a very low cost, easy to put in place way to raise capital. And that's a good reason to do convertible notes. Convertible notes as a bridge round is a harder sell. So what I mean by a bridge round is you've already done a priced equity round. You didn't achieve the valuation increase that you expected from that round. Maybe you didn't achieve the business results. So you're going out and doing a bridge round to bridge the gap for the next equity round. If you're going to do that, typically it's going to be the existing investors that fund that because it's hard to get a new investor to do a bridge round. It's not exactly viewed as a great situation. That means that you probably either raised money at too high a valuation or didn't have the results that you were hoping for. My recommendation is rather than a bridge round, just do another equity round and kind of take your medicine on price. But you can reset the management pool to kind of reset the incentive plan for the employees so that they don't get diluted too much. A few more notes about notes, and this is probably my favorite background image. It's the guy with the hangover wearing the unicorn hat, which I thought was just very fitting for kind of some cautionary points about raising capital. There are different ways to have a true hangover from a round of fundraising. One is when you invest or when people invest at a really high valuation, like I said on the last slide, again, it can be very difficult to raise your next round. So incrementally raising at valuation that you can justify, in my view, is a much better path than just because you can go raise a big amount at a big valuation. Doesn't necessarily mean that's going to be best for your business. And note terms do matter. People will assume that the valuation cap is the price on the next round. So while you are punting that valuation decision down the road, you still have to draw kind of a circle around the valuation cap. The discount is there to compensate people for the risk. There's a couple of different ways to do a discount in the cap, probably beyond this discussion, but I talk about it a little bit. But there needs to be a connection between the amount, the duration, and the discount. So if you have a 5-year convertible note, you can't have a 5% discount because that means that you got in 5 years earlier for a 5% benefit. The typical discount is 15 to 25%. The typical duration is 18 to 36 months. And there's this thing called the qualified financing. And the qualified financing says, once I raise a certain amount, $1 million or $5 million in my next round, the folks holding the convertible notes don't have a say, they automatically convert. But that qualified financing amount needs to be meaningful. It should be tied to your financial plan. And you need to understand kind of what happens if you don't hit your qualified financing. I do, again, want to kind of point about if you do layer convertible notes on convertible notes, a lot of times folks will keep raising convertible notes because they think that it's delaying the valuation discussion. But there is this hangover effect that once you've raised too many convertible notes, the fund investors will start looking at your company on a post-money instead of a pre-money basis. And what do I mean by that? Well, let's say you're raising capital at a $5 million pre, but you've raised $5 million worth of convertible notes. Those are going to convert into the round, and the money's already been spent. So if that $5 million converts in, and you really don't get a lot of value. If it's $500,000, I'm not going to bother. We'll look at it on a pre-money basis. But if it's $5 million on a $5 million pre, I'm going to look at that business as if I'm investing in a $10 million valuation business, not a 5. And when I start looking at revenue multiples and et cetera, 10 million versus 5, it's going to be a completely different decision. Kind of a note on how notes convert, and I'll talk about a resource where you can learn more about this. But there's a couple of different ways that notes can convert. There's a pre-money method, a dollars invested method. Some of these are a little more investor friendly, some are more entrepreneur friendly. It's important to kind of understand up front how you're going to do this. And this is, again, why if you have your cap table already mapped out and you can show that to investors, you can clearly show them what your expectation is around how notes convert. This math on this slide actually maps to a convertible notes primer on the Cooley Go website, which I'll talk about. So you can refer to this later as you read kind of their primer. And this was my own mapping kind of their primer to teach folks within our firm this aspect of how notes convert. Preferred equity comes in a lot of flavors, and there's a lot of bells and whistles. So it's beyond the scope of this conversation at the time that we have, but just to touch on some key points, there's the priority or the preference versus common. There's dividends and dividend rates. There's whether or not dividends accrue, whether or not they need to be approved. There's liquidation preference. There's a participating preferred. There could be a cap on the participating preferred. There are redemption clauses, downside clauses, anti-dilution, et cetera, et cetera, et cetera. The reason that people like to do convertible notes is a convertible note can be literally a 3-page document. A preferred round is dozens, if not potentially hundreds of pages of documents. So there's a couple of books on this page that I highly recommend that go into term sheets and valuations, the deal terms, and then venture deals. So you can refer back to this slide, but those 3 books, if you read just
Jason, I don't know if you can hear me, but I think you've been frozen. If everyone can stay on the line, I think Jason's dialing back in.
You guys have me?
Yes, you're live again.
Sorry about that. Not sure what happened. The beauty of technology. Let me just get the presentation back up here. All right, do you guys have the presentation back?
Yes, it's back on.
Sorry about that. So some online resources. Cooley Go, again, is put on by a law firm called Cooley that has some nice primers, some document generators. Y Combinator has a bunch of their documents and templates. There's a website called Series Seed that has a whole set of Series Seed financing documents. And then the one that we like and use a lot is the National Venture Capital Association has their NVCA model documents, which we use for deals, and that keeps it straightforward. Lawyers know those documents already backwards and forwards, so it usually also keeps your legal costs down. So just kind of some points on ways that structure can turn off investors. So I kind of mentioned safes. It's okay for incubators, friends and family. Funds tend to not like safes. Some firms don't do convertible notes. Some do. We do. Just ask. They'll tell you. Again, convertible notes for the wrong reason. Convertible notes that auto convert at common at the cap at the end of the term. It's something that lawyers love to recommend and investors usually cringe at. So just be careful. And if you don't understand what that means, is it basically means that if you don't have a qualified financing, that your note holders automatically convert into the worst security for them at the highest potential valuation for them. So that helps you understand why investors don't tend to like that. And again, there's kind of these different forms of hangover, too many convertible notes, even too many layers of preferred. later rounds that sit, as we say, pari passu with prior rounds, meaning that typically the last money in wants to be the first money out. But if you have all your rounds sit pari passu, that means that all your investors sit at the same level. And that's hard for the new investors to take. And again, kind of an ever-growing stack of preferred return. Investors want their preferred to convert, right? They need the preferred security as downside protection. It's their way of protecting their investment for their investors in their fund. But no equity investor is investing hoping to get 8% on their money. They want the company to do great. They want that preferred to convert. But if you have too many rounds of preferred, that stack grows and it gets harder and harder to convert. Again, another reason why I really recommend doing that cap table exercise and mapping out what you think the future rounds would be and the waterfall, because it becomes very apparent in that waterfall kind of what those note hangover or preferred round hangovers are. So a few other ways to turn off investors. Not showing up for meetings. I know things happen, but my recommendation is, investors are usually pretty sympathetic. Just make sure you have their cell number so that if you're stuck in traffic or tied up on another call, you can text them before the other call is going to happen. A lot of times investors just have meetings back to back, and so it might be easier for them to just reschedule. Asking investors to sign an NDA. Again, sometimes firms will do that. Sometimes it's a turnoff, so just ask them. Not having a data room ready. So it's frustrating to hear this great pitch and to be anxious to dive into a company and then, it's frustrating for an investor to hear this great pitch and to be excited to dive into a company and then have a company say, well, our data room would be ready in about a month. So just have your data room ready to go. It's okay if you're still adding stuff to it, but have kind of the base set of stuff there. You need to know your numbers. You need to have a detailed financial model. You need to clearly define your team and roles. So a lot of times we see a company where there's co-founders, which is great, but they all want to be co-CEOs. And investors want to know who's in charge, what's your decision tree, who's reporting to who. So kind of having co-founders all be like 3 co-CEOs is usually a red flag for us. Not having the business incorporated with proper legal docs. You want to have all of that done in advance. And I know it costs money, but to, again, have people ready to do diligence and say, well, I have my lawyer waiting to actually establish the LLC or whatever, is kind of a red flag. And then leading with deal terms is kind of a catch-22. And probably the most important thing is having unrealistic valuation expectations. And it's okay for you to think highly of your business and to shoot for a big valuation, but you got to do your homework and know what's realistic. So why are you raising money? Kind of bringing this back to where I started. Rule number 1, you're raising money to fund the growth of your business so it can achieve its full potential. Rule number 2, you're raising money to find great partners, the best partner for your business, so it can achieve its full potential. If there are any questions, refer to number 1 and number 2. So I know it's easy for me to say this being on the investor side of the table, but it really is important that you're not raising money just to achieve a certain valuation. Too often I see if companies focus on that too much, they get pulled way into this fundraising vortex, and it causes them to essentially spend so much time fundraising that it takes them away from their business, and it can hurt their business. And really the important thing is once you raise capital at a high valuation, you own it. There can be real implications if you can't live up to that. So think more incrementally, kind of build into your valuation and keep raising at higher valuations down the road versus these startups that I see that are still at the formative stage or raising way too much money, which means they have to raise at a really high valuation. And if you crush it, that's great, but more often than not, it doesn't happen. So quickly, some valuation traps. Valuation is more art than science. There's no right or wrong answer. It's only what can be agreed to. And again, higher valuation now can result in fewer options in the future. It's a bit of a paradox. If you can't live up to a high prior valuation, it can be very painful. In fact, there was a whole, if you watch the show Silicon Valley, there was a whole episode around people a guy that had raised a too high a valuation and it killed his company. And many companies can fail from spending too much time on fundraising. You want to get it done and get back to running your business. I think it's important to note that not all valuations are equal. So you can't view the valuation in isolation. I get asked to participate in deals all the time where it's a really high valuation, but then when you peer into the terms, there's like a 3 times liquidation preference and all these other things. It could be a participating preferred, all these other things that juice the returns for the investors, and the effective valuation is very different than the valuation that the entrepreneur thinks they're going to get. And some advice is that the best path to a big exit is to actually leave something on the table for the next investor. And sometimes that means raising at more moderate valuations so that the person that's going to acquire it, especially if it's going to be another private equity firm, is going to have an opportunity to make a big amount on their investment. I see these in the news all the time, these unicorns that just raise money at some billions of dollars of valuation, and they're still very small in terms of company. And I don't understand how those investors are going to make money. Sometimes it works out, but if you raise money at $1 billion valuation, that means you have to all of a sudden make your business worth $3 billion just to make the minimum 3 times investment. It's important to understand that multiples will go down over time, and the multiples will shift from revenue to EBITDA. So you may, at your earlier stages, raise money at 5 times revenue, but then as you get bigger, it's kind of the theory of small numbers, right? As you get bigger, that multiple is going to come more in line with market, and you may be raising the next round at 3 times. It doesn't mean that your business is less valuable. It means that once you're a larger company, it settles into kind of the market norms. And then once you become a bigger business, maybe looking to be acquired, you're actually going to be valued as a multiple of EBITDA instead of a multiple of revenue. A couple of last points. Equity is incentive. So you want to have a good equity plan. Investors should want a good equity plan. And you do that by creating a new pool as part of a round of funding. And so as you create future rounds, you can always kind of increase that pool or create new pools, which will allow you to continue to provide equity incentive without diluting your employees from later rounds. And then my last point is understand the difference between pre and post valuation. Understand the difference between equity and enterprise valuation. They're really important, and I've seen folks that have signed term sheets thinking that they signed a pre-money versus post-money, and it was the opposite, and similarly, equity versus enterprise. So just as an example, the difference between equity and enterprise valuation includes the debt. So I've seen people that think they're signing up for a certain valuation, and then when they go to calculate the share price, they have to take the debt off before that valuation gets divided by the number of shares, and they wind up actually selling shares at a lower price per share than they thought that they had signed a term sheet for. Quick note on valuation calculations. This always cracks me up, is that the Shark Tank math is usually wrong. They use kind of simple back of envelope math because it's TV. They'll say something like, 500K for 10%, you're valuing this business at 5 million. You're actually not, right? Because that's a post money. So when you talk about the amount of investment divided by the percentage that you're going to get, that gets you the post money, and then you subtract the amount being invested to get the pre-money. So in this Shark Tank example, when they say 500K for 10%, they're not talking about valuing the company at 5 million. They're actually talking about valuing the company at 4.5 on a pre-money basis. So that's what I talk about in terms of pre-money versus post-money. And then again, a note there at the bottom is understand that if you have debt on the business, there is a difference between enterprise and equity valuation. Final slide. If any of you like Shark Tank, you may also like The Profit. Love that show. And as he says, it's all about execution. I love this quote where he says, we're not going to wake up every morning wondering if we have a job. We're going to wake up every morning wondering how many jobs we have to do. So everything I've said is all a precursor to what's most important, which is the hustle and the execution. And that's what really matters. And that's why I say, get your fundraising done, get the money to drive the business, and focus on then the daily grind, driving the business and executing. And that's where you're really going to create value versus just trying to get that little bit more on valuation. So there's some bonus material that I'm not going to go through on this presentation, but you can look at it later. It's just a little bit more on the venture ecosystem and how VC works. And on that, I may have lost the Q&A. Let me, oh, no, there it is. Got to just bring it back here. So I'm going to try to get through some of the Q&A here. And certainly there's a lot of questions here. May not be able to get to all of it. And I'm going to just stop the screen share so you can see me. If I don't get to your question, my contact information is on the presentation. My contact information is on my website. So feel free to reach out. So one question was, why don't investors like safes? That's a great question. And so investors don't like safes because they want to know what price they're paying. And with a convertible note, there's at least a valuation cap. So when they report to their limited partners, which we have to do a lot of reporting, when they report to their limited partners, they want to say, we know we at least aren't going to pay more than X because there's a valuation cap, there's a time limit on it. And when a safe is completely open-ended, and a safe could have a valuation cap in it, but typically they don't. When a safe is open-ended, you can't send your report to your LPs and say, we know what we bought. You don't know the format, you don't know the valuation. You can't put a stake in the ground. And so when it's friends and family, when it's a family office that don't necessarily have to report, they haven't raised other people's money, that might not be as big of an issue. But for funds, we have a certain level of reporting. We have to do 409 valuations, et cetera, et cetera. We need to kind of have a sense of at least what's the maximum amount price we're going to pay, and technically when would that note be due. And so that's one of the big differences between a convertible note and a safe. It's kind of having just a little more clarity. Somebody asked, are you referring to a 5x return on investment? Yes. So when we model that waterfall, this is part of our pitch to our investors. So we invest in consumer businesses. So consumer businesses are a little bit different than what you would typically see in terms of Silicon Valley, right? The Silicon Valley fund, the model is, a significant portion, maybe 90% of our investments are going to fail. And so we're looking for 100 times our investment on an investment, 100 times return on our investment, because 1 or 2 out of 10 may need to return the whole portfolio. It's different for us investing in consumers. So we expect to have a higher hit rate. We're investing in more nuts and bolts companies, products on shelves. We're not looking for unicorns. We're not typically going to find the next Facebook. So we need a higher hit rate, and we then expect kind of a lower return. So yes, we are modeling from a 5% to 5 times to 7 times return on our investment, whereas a typical fund that's investing in more moonshot opportunities might be looking for a 10 times or even 100 times return. So that's where it's important to understand the type of firm that you're talking to, what their expectations are. That's why firms tend to focus on either moonshots or we focus on consumer, because you're building a portfolio that's mapping to your expectations and managing to those. Somebody asked, can you clarify what you mean by an exit and also bottom up versus top down? So, when somebody invests in your business, even though they might be on your board or an advisor, they're largely not in control of what happens, but they are expecting there to be an exit. And so when we talk about a fund has a limited life. Usually it's 10 years. A fund needs to be wound down or wrapped up at a certain amount of time. So an exit means one of several different things. It could be that the entrepreneur builds the business to the point that the business is able to buy the investor out. It could be that a next stage investor wants to put a certain amount of money in, so that some of it's going to go to growth capital, some of it is going to be to take out or buy out the prior investors. It could be an outright acquisition by a private equity firm or a strategic, or it could be an IPO. And so when I talk about an exit, that basically means I've invested $1 million in a business. I need to have an exit where I have a liquidity and I am able to return that money back to my investors, because as an investor, that's what I'm in the business of doing. From a top-down, bottoms-up, again, this really has to do with the financial model and documenting your assumptions. So a lot of folks will look at their historical numbers. Let's talk about revenue. They'll look at their historical revenue and their historical growth. And they'll say, well, we've grown at 30% a year, so I'm just going to extrapolate my revenue is growing at 30% per year. As they like to say in the investing industry, past performance does not necessarily, indicate future performance. So what we like to see is we like to see the why. We like to see a bottoms-up analysis that says, this is the number of customers that I had, my average order volumes or my average sales per account. Here's the list of accounts that I'm going to get, or the amount of marketing that I'm going to spend in order to acquire customers. And here's realistically the number of customers that I can acquire, the average revenue per customer, and you multiply that into what my growth in revenue is going to be. And so by bottoms up, I'm talking about having all of the assumptions that show how you're going to achieve those numbers, instead of just extrapolating, well, my revenue is going to grow at 30% a year, my gross margin is going to get better by 1% per year just because, right? I want to see a gross margin bridge that shows a bottoms up analysis that shows I'm going to buy product at bulk, I'm going to get a better price on my packaging. That's a bottoms up analysis. Kind of on that point, how willing are Y Combinators convert safes into convertible notes? You really don't need to do that. The safes can just sit there and it just becomes part of the stack that's going to convert. So you don't necessarily need safe notes to convert into convertible notes. You could just have those as part of the layers of what's on your cap table. What should we include in the executive summary that's being disseminated? This is usually the high level couple of bullet points that are the first couple of pages on your slide, on your pitch deck. So what problem are you solving? What's the market? Who's the competition? Why are you uniquely qualified? And then a lot of times I see people that will put kind of the chart that shows what their plan is in terms of financials, might be revenue growth, it might be gross margins, and you just leave the numbers off, right? So people can kind of see the expectations around growth, but they have to then come ask you for the presentation or to hear the presentation to know what the numbers are behind that. So it's usually, we like to call it a one-pager. It's one page front and back, the tear sheet. It's going to be a handful of bullet points it's a teaser that gets people interested. And really the goal of the executive summary isn't to convince people that it's a good enough opportunity. What you're really trying to do is to qualify people as a fit. So if I get a teaser and it's for a healthcare deal or some technology R&D, that's not a fit for us. So that teaser gives me enough of a feel that says, that's just not going to be a fit. So it's as much about investors determining, is it worth my time from a fit perspective to sit down and kind of hear the 30-minute pitch. Sorry, they're kind of moving in real time here. When you raise funds from friends and family, do they have to be accredited? This is why it's important to have a good lawyer. So as a general rule, it depends on what kind of a raise you are doing. There's all sorts of SEC exemptions that dictate whether or not your investors have to be accredited and what type of information you have to provide. And so the rules around accredited investors, for those who aren't familiar, an accredited investor is a series of questions that the SEC puts out that they use as a proxy to determine whether or not an investor is savvy enough. And the rules around accredited investors are designed to, prevent people from being sucked into a Ponzi scheme, et cetera, et cetera. So the investor credit rules have to do with how much net worth you have, what your household income is, whether or not you're an entity or an individual, et cetera. And so the lawyer can walk you through the different types of raises. Crowdfunding has less rules around than versus if you're doing a big preferred equity round. And at the end of the day, being an accredited investor really is a protection for the company. So that's what you as an entrepreneur needs to know, is that if you have all accredited investors, it really protects you from litigation. So it's really there to help you. And if you take on somebody who's not an accredited investor, or you take on an accredited investor and you haven't verified that they're an accredited investor, it really opens you up. The SEC says that if you do that, you should be providing a higher level of information to that investor. And if you didn't do that, there is a higher risk that you could be sued later. So a lot of entrepreneurs look at the accredited investor rules as a hindrance, and they actually should be looked at as a protection for you as an entrepreneur to, quite frankly, keep you from getting sued if things don't go wrong. There's a question of what are the typical percent ownership for founders after the seed and Series A? That's a great question. And while there's no right or wrong, there are kind of some rules of thumb. So, if you take on a friends and family round, you're generally only going to give up, maybe a single digit, maybe 10% of your company. And again, it all depends on the math. After a Series A, you may be diluted down to, 20 to 30% of your company. And, the goal as an entrepreneur, and I'm saying this as an investor who wants to have as much of a stake in the company, right? Your goal as an entrepreneur is to maintain enough of an ownership stake that you have a certain level of control. And that doesn't always mean 51%, but 51% is certainly a proxy because control can be through your board as well. And so depending on how many follow-on rounds, Series B, Series C, et cetera, as a investor, and again, this is a good reason to map out that cap table. As an investor, I want the employees, especially the management team, to have a meaningful stake. And so another good way to look at this is, well, when a private equity firm buys a company, if they do a management buyout or an MBO, they will typically carve out between 15 to 25% of the equity for the management team when they reset the clock. So that's a good target to have when all is said and done, when you've raised all of the capital to the point where you think you're going to exit the business, is that you want 15, 25, maybe 30% of the equity in the hands of the employee. And your founders, or CEO, if the CEO is not the founder, should have a meaningful, largest chunk, which could be a single digit, but preferably, a 10 to 15% stake. And the investors should want that incentive. So while that's a more convoluted answer than probably the simple answer, again, that's a good reason why you want to have that cap table that maps out your future rounds so that you can know what I'm giving up today is going to get me to the end point that I want to be at when we no longer need to continue to raise money. And you need to be comfortable with that as the entrepreneur. Should we pay much attention to tax issues during fundraising? If yes, how? Yes, you should. And there's a pretty big decision that needs to be made that impacts your tax issues, which I didn't touch on because it's a whole other topic in and of itself, which is should I be an LLC or a C Corp? And that very much dictates or impacts not just your taxes as a founder, but the taxes of your investors. And so the very quick answer on that is, if you're an LLC, you're a flow-through entity, which means you don't have the problem of double taxation, but it flows through to you, the individual, and to your investors. And there are some pitfalls of LLCs based on what your big plans are. For example, if you're an LLC, it's hard to take an LLC public. You generally have to convert to a C Corp to do that. And there's tax implications of that. There are funds that will only invest in a C Corp, and there are some funds that prefer to invest in an LLC. So, a lot of times what we see is when you start a company, you'll start as an LLC and then convert to a C Corp when you raise your first institutional round. And you very much have to think through and understand what those tax implications are, because there are tax implications every step of the way. The government has rules around what you can and can't do, the step up in basis when you value your company, when you convert to a C Corp and whatnot. So again, as somebody who likes to minimize the amount you spend on lawyers, I will say again, this is why it's important to have a really good lawyer. They will save you money, even though it's painful when you look at those hourly fees. And also, if you get a lawyer that's more versed on this stuff, even if their hourly fees are higher, they will end up spending less time because this is the stuff that they do all the time, and it'll wind up costing you less. So get a good lawyer. How would you structure the cap table when there are multiple rounds of preferred equity with different terms? And so if you go back and look at that example, I actually kind of show that with a Series A and a Series B. And where the different terms really impact you is on the waterfall. So on the waterfall, you are going to have to model out each layer. And the waterfall is going to be different based on the different preferred terms. Again, if everyone's pari passu, the waterfall, everybody has the same redemption time. If it's more typical, first money in is first money out, then let's say you've raised a Series A, a B, and a C. The Series Cs get the first money, and they get to make the first decision around whether or not they convert. And so if your Series C round put in $10 million, and for whatever reason you wind up selling your business for 10 million, guess what? The Series C are the only ones that get paid. So the cap table, you want to map out each round separately, which is why I show that cap table format as what's preferred versus what a lot of people do, where they just have one list of all their investors, and then they have a column that says what type of security that each investor holds. You want to show it by round because that makes it a lot easier to build your waterfall. And it's within the waterfall where you then play out the terms, and you actually do kind of a mock exit and what people would get if you sold the business at that different valuation level. And it's really nice because then you can go back, and as you're negotiating with investors, you can tweak the different terms and decide whether or not that's going to result in a waterfall that's acceptable to you. Because at the end of the day, your life isn't impacted by what percentage you own. Your life is impacted by what dollars you get out of the business when you're paid out. And so that's why it's important as part of that waterfall to show what's the cash on cash return for investors. That's the metric that they use, and the dollars the entrepreneur gets back out, because that's the most relevant to the entrepreneur. So go back on those slides, and you can use those as a template for doing kind of your cap table and waterfall. And again, as an investor, if I see that an entrepreneur has done that homework, it's really impressive to see. Try to get to as many here as possible. What proportion of your potential investor outreach time should be spent on trying to obtain warm introductions versus taking time to do cold call outreach to dozens of VC firms and larger angel groups? That's a great question. And this is why it's important to have something like HubSpot or CRM system where you can track everything you do, because based on the stage that you're at and the value or the proposition that you have as a company, it's going to be different for each company. And there's going to be someone that's created something that's amazing that can cold call 10 companies, get in the door in every one, and get term sheets from 5 of them. That's not usually the typical scenario. So the typical scenario is, you talk to hundreds of investors, and it's going to be, a lot of them are going to be cold calls. And, you have to track your process, and you have to track your traction that you're getting to constantly decide where are you getting the best reception. And if you're getting, great reception from doing cold calls, focus more time on that. If the cold calls aren't yielding anything, then you've got to focus your time on warm introductions. And so, again, not a maybe the specific answer that you were looking for, but you got to track what you're doing and see what the situation is for you. Question here: you said that the GP owes the money to the LP until they get the carry. That's correct. And so the way that it works is, if I have a $100 million fund, my investable capital will be closer to $80 million after all of the 10 years and 2% of the management fees. But I owe the investors $100 million before I make any carried interest. So before the investor makes a dime on carried interest, I have to turn $80 million into 100. And then on that first dollar after 100, that's when I can start making carried interest. And there's different ways to structure it. Later stage firms tend to have what's called a hurdle rate and a catch-up, meaning that they would need to pay back the original investment plus, say, 8%, and then they make carried interest. But then there's a catch-up so that if they make 200 million, it'll wind up being 20% of the 100 million upside. Earlier stage venture capital investors tend to have simpler funds that just are 20% on the next dollar. So if I returned 100 million, if I turn $80 million into 100, and I actually have some slides in the backup that show this math, but the basic math is, if I turn the $80 million into 100, return $100 million to my investors, and then we have another $100 million of upside, then my firm is going to take 20% of that, or $20 million, and I'm going to return $80 million to my investors. So the total proceeds from exit was 200. The total that I returned to my investors was 180 million. So hopefully that makes sense, and why I talk about the management fee is really a loan that I owe back. Now, if for whatever reason I take $80 million and turn it into $50 million, I don't owe that other $20 million. So it's technically not a loan that I have to pay back, but it's a loan in the sense that I have to turn $80 million into $100 million before I can collect any of my carried interest. So again, it's just important as entrepreneurs to kind of understand the incentives for your investors kind of as you are bringing them on. Somebody asked a question reiterating the difference between the J curve and the hockey stick curve. In its simplest form, when people talk about the hockey stick, they're talking about revenue. When you talk about the J curve, you're talking about the net profitability of the business. So the hockey stick revenue could be great, but your J curve could be so long that it could be like, well, we're going to lose money for 5 years, right? And that's a very different business than a business where the J curve says we're going to lose money for 18 months and then we're going to be unbelievably profitable, right? So as an investor, and again, it depends on the type of investor. If I were a tech investor that was invested in moonshots, I'm less concerned with the J curve. If I'm an investor that's looking at building a business that I'm going to sell, for example, sell to a strategic like a Pepsi or a Coke, then the J curve is important because whether it's a strategic investor or a private equity firm, they are going to be looking at, is this business making money? And you could have a J curve based on gross margin. You could also have a J curve based on profitability. Strategics are more looking at gross margin, and private equity investors are looking at profitability. So again, the net is when people talk about hockey stick, they're talking about their revenue. When investors talk about the J curve, they're talking about when do you become profitable. And you need to ask your investors kind of where that fits for them from a importance perspective. Somebody asked me the recommendations around executive summary, pitch deck, business plan, etc. Do you need these available for a friends and family round? I say this all the time to companies when they're pitching me. If you have friends and family, or you have investors that will do these terms or close the deal without the information that we're asking for, great, do it. That's our loss. So do what you need to do to get things done. If you've got a wealthy uncle that's willing to, just because you're in the family, willing to write you a check without having to put a full data room together and all this stuff, and by all means, do what you need to do to get the money raised. But in my experience, friends and family rounds lead to larger rounds, and for those larger rounds, whether it's filling in that round or raising the subsequent round, you do need to put all this stuff together. And also on friends and family, a lot of times friends and family will commit, but they won't write you a check until you have the definition around the round. And so a lot of times I'll see companies where it's like, well, I've got $250,000 that's been committed by my friends and family, but they won't write me the check until I have somebody like you who's a lead investor who will help me craft the structure of the round that they're investing into. And that's totally fine. So if you have a commitment for a certain amount of money from friends and family, but they haven't written the check yet, from an investor perspective, that's totally fine. The investors will then help, the lead investor will help you put together the round, negotiate the terms, and then you can go back to friends and family, and then they can invest into that structure. Try to get to a couple more here. Many businesses never create profits, hence no J curve, yet many VCs like them. How can you explain that? And again, it depends on the type of firm. So if you were an investor in Tesla, for example, in the early days, you knew that they were digging a big hole and they may not ever be profitable, right? I mean, that's a disclaimer that's probably in the early pitch deck of a lot of really big exits. And it's a matter of what is the strategy for your firm. So a lot of early stage tech investors are expecting a very high percentage of their companies to fail. And the companies that are successful may not be profitable if they're going to be acquired by a Facebook or a Google or something like that. So that's a perfectly viable strategy. And again, as I kind of said, each investor is going to be different in terms of the weight that they put on the J curve. But increasingly and more often for folks like us that are investing in consumer businesses, especially, the J curve is important because we very realistically could invest in a business that is successful enough that they just buy us out. And so we'll put in a redemption clause that says, you have an option to buy us out. We might pre-negotiate the terms, the payout terms for that. And if a business is so successful that they can just cash out their investors, that's great for us. But you're never going to be able to cash out your investors if you are always having to raise more money because you don't have profitability. And so it depends on the type of the investor and what they're looking for and making sure that they're a match for you. Curious about how important professional branding, logos, website, all of that is for early stage founders. How is it important to look polished and professional? You know what? There's actually a balancing act here. I just had this conversation with another company where you want to look polished and professional, but it's more about the content. And I had a company that was going to go to a design firm and have them spruce up their slides. And my comment was, it's actually could be a red flag. If you're a startup and you have slides that are too nice, it could mean that unless you were a designer in another life and you can say, well, I did these, it didn't cost us a cent, that actually is a good thing. But if they start looking in your financials and it's like, okay, you paid 10 grand to have professionally designed slides for a pitch deck for a company that's raising money, that probably wasn't a very wise decision. So, you want to understand what stage you're in and understand what's important. And so for us, for example, investing in a consumer business, right, the branding is very important. We're investing in the brand. The logos and the website design, that might be something that you're raising capital to have done. So we want you to have thought through the brand, but the brand is not your logo. Creating a great logo might be something you do with the capital that you raise. So, again, it depends on the company, and talk to your investors, that you have, that you're giving pitches to, and ask them their feedback because it's going to be more specific to who you are and what you're doing. Do VC investors look down or shy away from startups that had a particular type of early stage investment, crowdfunding, for example, too many investors on a cap table, unaccredited investors? Yes and no. I mean, some of those things, yes, some of those things, no. So if you were in an accelerator and had safe notes, if you did a crowdfunding or a Kickstarter, no, those are great things. That's a great way to kind of get a business off the ground. Crowdfunding is a great way to hustle and get some product out the door. Again, to my point in the presentation, if you have too many layers of convertible notes, you do get into a kind of what I call the note hangover effect. But the point I will say about crowdfunding is this: make sure you're doing crowdfunding the right way. So if you're doing a Kickstarter campaign, a pitfall that I see companies that have done this is they'll run a Kickstarter campaign, and Kickstarter is meant to essentially be a pre-order program for your product. So you're getting people to invest by buying the product before you've made it, and then you should be using that money to fulfill that product. And so the challenge as an investor becomes, well, I had a bunch of people that pre-ordered the product, and I took that money and I spent it on marketing, and I spent a bunch of money to build the brand, but now I got a bunch of people there that don't have product, and now I'm raising money to fulfill those orders. Now that becomes a bit of a catch-22, because the point of doing a crowdfunding or a Kickstarter campaign was to basically get product in the market, not to go do a bunch of marketing. You might use some of it for marketing, but you want to come out of a Kickstarter campaign showing the results of, we did pre-orders, we got the product made, here's the number of people that were willing to buy it, and here's the number of people that would be willing to buy it again or recommend it. And if at the end of a Kickstarter campaign, You just have a lot of people that are upset because you took their money and didn't deliver, and you need more money to deliver. That does more harm than it does good. So hopefully that helps. What are the typical multiple ranges for early stage CPG companies? I'm so glad you asked that question because it is a moving target, and it has definitely been impacted both positively and negatively by COVID. And so just to kind of touch about the impacts on COVID. So for example, a CPG, like a food or a beverage company, right now, it's great in the fact that people are eating at home and stocking up their shelves, but it's also now really hard for an emerging brand to get discovered because COVID has completely changed the way people shop. So you would think that a food business is more valuable today than it was a year ago, and it's actually not the case. It's the case if you make frozen pizzas and Oreos because people are stocking up on that and everybody knows who Oreos are. But a CPG company is very limited right now in the fact that they can't run promos, or they have limited promos. They can't do sampling in stores. It's a lot harder to get discovered. You're spending a lot more money on being discovered online. And so the multiples have gone down. And so the general guidance that I give people is pre-COVID, if you had a great CPG business, your job was to convince an investor that you were worth more than 3 times revenue, 4 times revenue, or 5 times revenue. Those were the 3 bars that you could hit. And it was very rare that a company was raising capital. It happens, but rare that a company was raising capital at greater than 5 times revenue. The sweet spot was kind of between 3 and 4. Everything's gotten knocked down a notch. So now you're convincing me that you should deserve more than 2 times, 3 times, and it's very rare to get 4 times. And so a lot of companies, my advice to them is if you had a good raise and you have all of those docs from a year ago, just try to reopen that raise and raise on what you raised a year ago, because you've made a year of progress, but the situation has made it harder for valuations. So to be able to go to the market and tell people you're getting the valuation today that people paid a year ago is one way to sell that. But I've seen a lot of really great CPG businesses that have grown 20, 30, 50% that are raising capital right now at 1 to 2 times revenue. And there's exceptions to every rule. If you're in the CPG space, if you saw the Laird Superfood IPO, everyone is still scratching their heads on that. If you don't know the Laird Superfood IPO, go pull the S1, go read the S1, go watch the stock. It's an absolute counter to everything that I just said. They raised a ton of money at a crazy valuation on a business that was only 10, 20 million of revenue and losing 8 or 10 million. So there's an exception to every rule, but in terms of my guidelines, right now, even for CPG companies where people are stocking up at home and you might be selling a ton online, it's tough. It's tough right now there from a multiple perspective. If you can get between 2 to 3 times revenue, you're in a fairly select group of companies right now. And to tie into that, do you as an investor adjust expectations in a recession or COVID circumstance? If so, how? So every firm, when COVID hit, had to make a decision of how they were going to adjust. And were they going to adjust in terms of valuations? Were they going to adjust in terms of check sizes? Were they going to adjust in terms of, a lot of firms just said, we're not going to make investments for 6 months. Some firms stepped on the gas and said, I'm going to invest in a bunch of companies. I can talk about it in terms of my firm. We very specifically said we are not going to pull back on doing deals, but we did pull back on the size of the check. And we did now start looking at companies through the lens of COVID. And so there are some industries that are getting hit harder by COVID, and some that are benefiting from it. So, pre-COVID, we looked at investing in multi-unit retail and restaurants. We're not looking at any of those deals right now because obviously with everything being closed, there's just so much that's hard to predict with that. But if you've got a great frozen pizza business or something like that, that's probably really cooking right now, those are the areas where we're focusing more of our time. See if I can find 1 or 2 more here. How much startup capital do founders typically put in? Could this allow founders to skip the pre-seed seed rounds and reduce dilution? That's a great question. And so when I look at what folks have invested in the business, I look at more as relative to your net worth, right? So if you are if this is your third startup and you've sold two businesses and made a ton of money, and you wrote a small check into this new business, maybe you wrote a $100,000 check after you sold a business for millions and millions of dollars, then it's a red flag. It's a red flag. It's like, this is your business. Why aren't you putting in more money? But if you've just gone out and worked for 5 years and you've saved, $100,000, and it's basically represents the bulk of your savings, and you're putting it all in the business, that same $100,000 check means the world to investors. So not all dollars are the same. It's all relative to your situation. And so what we want to see is, based on your situation, have you put some skin in the game? The red flag for us as an investor is anybody who has started a company and not put some of their own money into it. It's all been other people's money. I, as my firm, have invested a ton of my life savings into my firm. I'm expecting you to do that in terms of your business. And what represents a significant investment for you is going to be different for the situation. If you are able to invest enough money that you can delay raising money from other people, that's a great thing. But I would also caution you to say that you get a lot of value, or you should get a lot of value out of bringing on the right investors. So if your life savings, if you take stock in your life savings and you say, I could put this into business, maybe you put half of what you're willing to put in the first round, and then you are willing to invest alongside your new investors in the next round. It's a great show of faith and commitment if you actually invest alongside your investors, because not only are you putting more of your money in the business, but you're accepting the same terms that you're asking your investor to accept. So if you're raising, say, $500,000 and somebody comes to me and says, I'll put in 200 if you put in 300, that's a huge, huge bonus for us to know that the person is investing their own money on the same terms that they're asking us to invest. So hopefully that answers that question. Let me try to find one more here. What are the best practices for placing a value on sweat equity? Obviously, when you first start a company, your sweat equity is going to be 100%, and you need to look at it in terms of a percentage versus dollars. When I look at a company and look at the cap table, I'm looking, as I said previously, about how much did the person put in, but that's depending on that specific situation. So, when you put in your sweat equity, if all you have is $10,000 and you buy 10,000 shares at $1 a share, if that's your life savings, that gets you 100% of the sweat equity. That's kind of the relevant data point. And so again, kind of to my point on cap tables, this is why after the sweat equity round, it's all matters about what happens next and what gets you to the point that you're not raising capital anymore. So those with sweat equity, when it goes from 100% down to 80 to 60 to 50 or whatever, when you talk about sweat equity and how you divide that up around co-founders, that similarly, you're starting with 100% of the pie and you need to divide it up accordingly. And so if there are 3 co-founders that are each contributing an equal amount of capital, an equal amount of sweat equity, the common thing to do is that you each have a third of that initial allocation. But that's really, again, dependent upon your situation. If you have one founder that's worked on something for a year and then brought on a couple of co-founders a year after they've put time and money into it, then maybe the new founders have significantly less than the original co-founder. It all depends on the situation. I've got a couple of questions in here around different industries, fintech, different markets, overseas markets, et cetera. My advice on this stuff is, really seek out the firms that are focused on your market, that are so focused on your industry, your geography. And then this is why it's so important that when you present to somebody that you have that you follow up and you have a dialogue and get feedback from them. I'm more than happy to share my thoughts with folks around CPG multiples and what I'm seeing in the market and all that kind of stuff. But if you come to me and ask my advice on fintech, I really don't know. But I'm happy to kind of talk to CPG startups, and a fintech firm would be happy to talk to you. So make sure that you never miss an opportunity to get from the feedback from the folks that are experts in that area. The investors aren't going to be smarter than you in terms of how to build your business, even though many investors will pretend they're smarter than you on that. They're not. But where they are smarter than you is, we look at hundreds of deals per year. So in terms of what the market is doing, in terms of multiples and valuations, and quite frankly, when it comes to execution, because we look at so many deals, we can be great advisors to say, here are common pitfalls, or here are things that I've seen that have been successful. But if I thought I knew how to build a better company than you, I should be doing that company, not investing in you. I'm investing in you because you're the smartest person to go build this business. I think we, for the most part, covered the questions, and I think we're at an hour and a half. So I will pause here and see, I guess, if there are any other questions coming in, or if at this point, Cerise, we don't know what time you wanted to end this.
Yeah, I think we're good. I haven't seen any new questions come in a bit, so
Yeah, I think I covered them all. If there's one that I missed, looking back through them as they were coming through, again, feel free to email me, and I'm happy to chat further.
Well, thank you so much, Jason, for taking the time this morning, this evening, depending on where people are for the session. Super valuable. And for everyone that's on the line, again, we will make the recording available on our YouTube channel. So just look out for that email from me shortly.
Thank you, everybody. Hope it was helpful.
Thanks. Have a good one.